Welcome back to another video. In this video, we're going to talk about factors of production, but more specifically, the market for factors of production. Now, recall that back in the beginning, way back, let's go back in the Wayback Machine to the beginning, and we talked about 5 factors of production: natural resources or natural capital, labor, physical capital, human capital, entrepreneurship. And this is going to talk about all these different factors, but what economists tend to do is they tend to boil them all down. One, they don't consider entrepreneurship as a factor, which I do. Two, physical capital can be lumped all into one, land and natural resources can be lumped up into one, and labor can be lumped up into one without considering human capital. Make it easy. Let's lump it all into 3. And then of the 3, natural resources, although there is a market for them, we also don't consider that because they're unlimited, as if. It's unlimited. There's unlimited amount of natural resources. We don't know how much there is. We can't quantify how much there is. Therefore, we're not going to consider that. But we do know how much labor is in the civilian labor force. That is a known variable. We know that. As of recently, it's 160 million people are considered part of the civilian labor force in the United States. We know capital. We know how much capital there is. We know how many machines are out there, how many machines are depreciating or degrading and need repair, and how many new machines are there. This is all known information. It's quantifiable. It's a known number. We can actually figure that out. I don't know how much capital is in the United States, but it's known. We could look it up if we wanted to and find that out. So we're going to focus more on capital and labor. Now, labor a little more focused because we are labor. You, me, we are part of labor, and we know what labor is because we are part of labor. And because we are part of labor, we know enough about the demand for labor and the supply of labor. We are suppliers of factors. We supply the factors, and firms, companies, businesses hire us as labor. And when they hire us, they pay us a wage or a salary. Now, the only reason why a company will want to hire employees is because they have a need for employees. They have a need to produce something. Remember the 3 questions: what to produce and how to produce it. Well, part of the what to produce is to know what the product is, but how to produce it, we have to incorporate in that question the discussion or the decision on how much people are we going to need to produce it. We need a certain amount. We need to have that many people. So that is what is called a derived demand. It's derived based on the company's decision to enter the labor market to hire people, or hire more people, or to lay off people if they have too much. And so it increases the supply of labor. When you lay off people, there are people unemployed. So the decision to supply goods in another market is the reason why a firm will get into the labor market, and that's why they will have a demand for it. So if there's a need for a product or an increased number of product, then they're going to go into the labor market because now they have a demand for it. So that's why it means by a derived demand. Now, as a derived demand, the demand curve is very similar to the other curves that we've seen previously, the supply and demand curves. But the supply curve, remember that the supply curve is the supply of factors. In our case, we're talking about labor. So the supply of labor. And the demand curve, same as we've seen before, is the demand by firms. So let's say that and so there's a similarity between the two, and there's a connection. The connection is if there's an increased demand for a product in the goods market or the products market, then there will be an increased demand for labor in the factors market. So there's an interconnectedness. If there's a shift, we talked about the shifts in supply and demand. If there's a shift in if there's a shift in demand, a positive shift in demand, if there's a positive shift in demand, which means it's shifting to the right, then that means there's going to be an increase in quantity demanded. If there's an increase in quantity demanded, then the firm must meet the need and See a need, fill the need. And if we fill the need of higher quantity demanded in the market, then we have to get it. We have a need for more labor to meet that demand. So, but as far as classicists are concerned, there's some assumptions that they make with the labor market or with the factors market. That one, that firms are competitive both in the products market and the factors market for goods and labor. They are price takers, meaning that they pay whatever the market wage would be, that equilibrium wage. And they also receive the price from whatever the market equilibrium price is going to be. They don't have a choice on that. So they're price takers. And that also another big one is that the firm is a profit maximizing company. So they're going to meet that marginal cost, marginal revenue sweet spot. Sweet spot number one, or profit maximization point I talked about before. So let's talk a little bit about why would a firm agree to that price, or and if they have that price or that wage, what would be the consideration? How much how much labor are they going to buy based on that? Buy meaning hire. So we have to look at what's called the marginal product of labor, the marginal production. How much does one more labor add to the output? How much more does that fifth person produce versus the fourth person? And you also have to remember that there's diminishing returns even in the labor market. That especially in the short run, there's diminishing returns, meaning that every new or additional employee will have a smaller marginal product, meaning that they will contribute less and less until a point where they're not contributing, they're actually making it worse. So we'll have it. So then we'll look at that in a moment, but I also want to introduce what's called the value of the marginal product of labor, the VMPL. The VMPL is the marginal product, that additional output that one more unit of labor is going to produce, times the market price for that labor. So that's their value added to the total. So if there's 10 products, but the fifth person only made one, and it's $12, then that fifth person, the marginal product is one, and the VMPL, the value of that marginal product, is 12. And diminishing return sets in as the increase in the number of products and the number of labor. So we'll see that in a second. Now here is a chart right here. I have a chart right here. And if you see that there's output, labor, units of labor, there's output, there's total output, here's marginal output. This is the marginal product, the MPL. And at a price, this is the value of the marginal product. And we're only going to hire as long as to the point where the value of the marginal product of labor is equal to the price or the wage. So it's very similar to marginal cost, marginal revenue, but we're focusing down a little bit. We're going to concentrate a little bit more on just the labor value, the value of the labor, and the value of the labor versus what the cost of the labor is. So that's very similar to marginal revenue. But we're talking not of marginal revenue of a sale of a product. We're talking about the marginal revenue that the labor is bringing in. That's the value of the marginal product of labor. The VMPL is the value of the marginal revenue of that one employee. So we're concentrating not on just the whole production. We're talking about what that one employee's productivity is. That value of that productivity. How much production does that one person add to the system? And at that VMPL, if that's equal to the cost, the marginal cost, which is the wage. For each employee, we're paying the same amount. That's the assumption here, that it's your price takers, which is what is that wage in the marketplace, the equilibrium wage, that's where we're going to pay. So we're looking at this units of labor, and we're looking at the output. Now here's the value, the marginal product of labor, the MPL, the marginal increase based on the increase in number of production of the labor. And this column here is the value of the marginal product of labor. And this one is going to be the wage. So if the wage is equal to the VMPL, that's the level of hiring you want to do. But what if the price goes down? If the price goes down, then you will hire less employees. That's why there's layoffs. So we're going to lay off down to where the VMPL equals the wage, because the VMPL now is less because the price is less. If its price is less, we're going to supply less. So if the price is less, the VMPL will be less. So if it's $12, but it goes down to $6, then that fifth person only has a VMPL of $6, not $12 anymore. Or what if the wage goes up? Let's reverse this and see what happens when the VMPL is back to what it was before, but the wage goes up. If wages go up, then we need to still cut down on a production. So you see, the decision is not just a whimsical decision based on what the management wants to do. There's a defined way of why this decision's made. Why the decision to hire more people or why the decision to lay off people is based on the price, market price, and the wage. It's assumed that the production line doesn't change. That's one of the other assumptions that is a bit faulty here, is that if you start seeing employees being laid off, your buddies laid off, that's not going to really enjoin you to want to work any harder. So it tends to make it more difficult to produce. So your marginal production, your MPL is going to start going down, your VMPL starts to go down, then it makes more sense to now lay off more people. It's a bit of a vicious cycle. Now let's talk about shifts in the labor demand curve. As I said, if the VMPL, when the demand for labor is based on the VMPL, and technological changes. If there's a technological advance that can raise the marginal product of labor, then there's going to be an increased demand for labor. If there's labor-saving technology, not just technology, but labor-saving technology, there'll be less demand for labor. And with that, it's quite relevant when the computer was introduced back in the 50s, and the more and more people were using computers. If you look back or watch some old-timey TV shows or movies where they have an office setting and then there's row after row after row of accountants sitting at tables with a little adding machine that they go tick, 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 ching, tick, 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 ching, and they have these big ledger books that they're writing and scribbling and bibbling and doing tick, 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 ching. All of these rows after rows of people working on that. With the advent of the computer, we were able to computerize all these ledger books, and it already had embedded in it calculators. And those calculators, those computerized calculators, did all the functions we needed. One person can handle all the ledgers all at once. And if you're talking about accounting software, even better, accounting software, you can program accounting software to go from one GL to another GL with one JE transaction. So one journal entry transaction, it knows which GL to post it immediately. So it's a one step, put the JE in, and the GLs are posted immediately. So there's no more step by step by step. I've just taken away a bunch of people's jobs. But it's labor saving because only one person needs to do it. That's part of the technology change. The technology change would increase demand for labor to be able to know how to use the technology. But the computer, being a labor saving device, means that we don't need as many people, especially if it's already programmed. Push a button, boom, everything's done. Now, let's look at the other side. Let's look from the labor side. Labor people face a trade off. And that trade off is work versus leisure. That you don't want to be working 24/7. You don't want to be working on Christmas Day or any holiday. You want some time off, whether it's a holiday or it's a vacation time, you want some time off. But if too much time off, you don't earn any money. So you're not consuming. And so consumption goes down, people don't buy things, or your savings goes down because you don't have enough money to buy and to save because you're not working enough. So what's the trade-off? Well, I could work all day, all night, or I can sleep. That's a trade-off. Leisure doesn't mean goofing off. Leisure is time away from work. Either working or not working. So if you're not working, you're home relaxing with the kids, with the family, you're watching TV, you're going to a movie, or eating out to dinner, or just having dinner with the family, or just eating dinner. Sleeping, going out with friends, all that is non-work related. And if it's non-work related, you're not getting paid for it, yet you're paying money for it. Where are you going to get the money from? You have to go to work. So the trade-off is work versus how much time is not work. And it reflects on how workers' decision about this trade-off is what is the opportunity cost of leisure? How much is it really costing me to not do anything? Labor supply would be also attitudes of work towards work and changes in taste in that you don't want that environment. Maybe other labor markets are available, so you switch from a market specifically for one industry or one sector of an industry to jump into another one. I did that. I was working in business for over 30 years. I was in business. And I switched, so I'm no longer available in the business labor market. I'm now teaching, and I do that with all my time. And I enjoy it more, so it's my taste towards my attitude towards work. The grueling 9 to 5 was too grueling for me. I got out of that train before the stop. I jumped off on the tracks, and I switched tracks to a new train. And as the train was passing by, I jumped on the higher learning train and became an instructor. And I'm enjoying it much more. I'm having a much greater work-life balance, and I'm enjoying myself. But I changed labor markets, not the whole labor market, but the specific labor market for instructors versus business. Immigration also is a huge one, where we have imported labor. Immigration, people coming in, which also adds to the labor force, but it also changes the dynamic and the tenor of the labor force towards one direction or another. And if we have more immigration, that's where you hear the argument that more immigration takes jobs away from citizens. But it's good for businesses because they may accept a lower wage. Now, a similar situation is there we find with capital. But the slight difference is we don't have trade-offs with capital. Capital doesn't decide whether to work or not work. It doesn't goof off. What we do have is what's called depreciation. Capital, physical capital, breaks down. It starts to degrade over time. It's not going to last forever. And so we have to consider the degradation of capital and the appreciation or the manufacturing of capital. There's a balance there too. In the capital market or the physical capital market, there is still a very similar VMPL, but we do a VMPC, the value of the marginal product of capital or the marginal product of capital. And so the similarities is there, but the differences are we don't have to worry so much about imports versus domestic labor, import versus domestic capital. So the market is similar, but not exactly the same. There's no labor saving device when it comes to capital. Capital is the labor saving device. So what we do though is the word for the price of capital is not wage. Wage is the price of labor. The price of capital is called rent. And that should take you all the way through these chapters on the market for factors. See you next time.